Hi, everyone, and welcome to the 7th session of the Massive Open Online course for the Master's Degree in Digital Currencies by the University of Nicosia. I'm Andreas Antonopoulos, and I'll be answering your questions from the previous week's homework and also from the live chat. Hi, everyone on the live chat. Good morning to you, or good afternoon, or good evening, wherever you may be. Let's start with questions on the topic of alternatives to Bitcoin and the overall cryptocurrency space. Joya asks, can you comment on JP Morgan's engagement with Ethereum after Jamie Dimon's negative statements on Bitcoin? From what I understand, JP Morgan is not only engaging with Ethereum, but also with other technologies such as Hyperledger, and even trading Bitcoin for institutional clients. So I think it's fair to say that an executive's personal opinion, even if promoted as part of the company policy or expressed in a way that makes it sound like a company policy, doesn't necessarily mean that the whole company is following that opinion. And arguably, that would be a good thing. You know, the boss doesn't know everything and shouldn't know everything. And I think Jamie Dimon has clearly said that he is not an expert on these things, and he clearly employs many who are experts on these things and perhaps are taking a different position. So I don't see any particular conflict of cognitive dissonance between those two possibilities, that Jamie Dimon says one thing on TV and the traders trade, the blockchain analysts analyze, and the Ethereum team builds. Regardless, I think it would be strange if the entire organization followed in lockstep the opinion of its leader. I think it's probably not a good thing. Ademar asks, what are the differences between Dash and Monero? I would say probably the two major differences, which are also the strongest differentiators of these platforms, are the fact that Dash has a governance and participation system based on master nodes and using nodes as a form of staking that is unique among cryptocurrencies, and has a proof of stake system that is unique. Monero primary feature, I guess, is ring signatures. So using signatures to obfuscate the source of inputs in a transaction and to provide significant privacy. Now, Dash also has some privacy features, but those are far less developed than those in Monero and primarily involve coin mixing in the wallet. So the difference between coin mixing and ring signatures is that coin mixing is a process by which you simply you obfuscate the relationship between inputs and outputs by having multiple different payments combined into one, so that it's not clear which inputs and which outputs correspond to each other. Whereas ring signatures hide the sources effectively by having signatures applied in such a way that you cannot attribute the inputs to a specific address. So those are two very different techniques. And in some cases, they're combined. So you can imagine a system where you have ring signatures and you do coin mixing. So biggest differences in Dash from Monero, I think Dash is primarily differentiating itself in terms of governance and a mechanism for rewarding the operation of nodes and having those participate in the decision-making around both the protocol and the broader community. So for example, in Dash, if somebody wants to go to a conference to speak for Dash and they need to have their expenses covered, they'll have a vote with the entire community participating so that that can be a funded proposal. It's an interesting feature. And Monero is primarily focused on ring signatures and strong privacy. Leonard asks, Dash and maybe other coins use masternodes to share the rewards of mining, but they also freeze coins out of circulation. Is this a bona fide mechanism or an indication that the coin's value can be manipulated? No, I think you misunderstand the idea of freezing coins out of circulation. The reason coins are frozen out of circulation is because that represents a staking mechanism whereby those coins are removed from circulation to represent almost like a bond that that owner is putting down to vouch for their validation of the security rules. And so the coins are taken out of circulation for a period of time. Now think about it this way. When you're spending money on energy for proof of work, that's your spend. When you take coins out of circulation and you freeze them, what you're actually committing to the transaction or to the security of the algorithm, the consensus algorithm, is the time value of money. Meaning that if you have coins that are frozen out of circulation and you don't have those coins available to speculate, to invest, to spend, there is a cost to that, and that cost is the time value of money. So proof-of-stake systems require you to commit the time value of money against the security of the consensus algorithm. So that's not a contradiction. In fact, that's part of the mechanism of how Dash works. Larissa asks, why would people continue to use BTC instead of BCH? So that's Bitcoin, traditional Bitcoin, instead of Bitcoin Cash. If the upgrade, meaning the hard fork of Bitcoin Cash, is considered an improvement, so why would people continue to use Bitcoin if Bitcoin Cash is considered an improvement? And right in the question is your answer. Regardless of what my opinion is, the bottom line is that the market has expressed an opinion, and the opinion that the market has expressed is that Bitcoin Cash is not the same as the traditional Bitcoin, and as an upgrade, it's worth about 1/4 of, or 1/10, sorry, of what Bitcoin is. So the market has already expressed an opinion. You can disagree with that. You can say that the market is manipulated through various means like censorship and manipulation of media and whales and big holders of coins and sock puppets and all of this other stuff. But that's essentially what has happened. Is it viable to run a blockchain without a metacoin or altcoin attached to it? How can it function? Asks Jonathan. The purpose of a coin, the purpose of an intrinsic currency system within a blockchain, is so that you can have a system of reward and risk that is tied to the consensus algorithm that involves rewarding or risking the intrinsic asset. And that's part of the consensus algorithm. So the reason you need a currency is because the consensus algorithm builds security around that currency by using that currency to value risk and reward. And for example, in Bitcoin, you spend money on electricity because you're going to get reward in Bitcoin. In Dash, you commit coins to the proof-of-stake system so that you can get those coins back if you validate the security correctly. And so all of these things really have to do with how the consensus algorithm is structured. So can a blockchain run without an intrinsic native asset? Yes. It can run with a consensus algorithm that involves signing instead of mining, which basically means that instead of committing some kind of asset and being able to participate in the consensus algorithm anonymously, the participants of the consensus algorithm are vetted. They are restricted in number. They are known entities, and they sign blocks, which is also known as a proof of authority mechanism. Proof of authority mechanisms are primarily used in distributed ledger technology, as it's known, or private blockchains. And in that case, what you're saying is we will trust these 5 entities, let's say, and they will sign for blocks, and their authority is what is required. No proof of work, no proof of stake, no commitment of currency, and therefore you don't need a currency for that. Of course, that brings up another question, which is such a consensus algorithm actually secure? And in order to answer that, you have to define what your threat model is. Secure against what? So it's not secure against censorship or coercion of these 5 parties. It's also not secure against collusion between these 5 parties. But for certain use cases, that's not a requirement, so therefore that's fine. And it's certainly a much more efficient way than having an open, decentralized consensus mechanism where anyone can participate without being vetted. That's much less efficient. It uses either a lot of energy or it uses an internal currency, and that has its own complications. But what the benefits are of an open, decentralized consensus algorithm is that it brings very strong immutability and censorship resistance, because the participants are not known and can therefore not be coerced, and it's harder for them to collude. So again, it depends what your model is, but a blockchain can be run without a currency. Romain asks, thoughts on Metropolis Part 1 and any features it brings? So a bit of a backstory here, which is, what is Metropolis? What are we talking about here? On the Ethereum blockchain, there is a very specific roadmap that has been playing out over the last 2.5 years, which started with Frontier and then Homestead. I keep forgetting the names. In any case, a series of upgrades, planned upgrades, each of which was a hard fork, because the upgrades are non-backwards compatible. And Ethereum's model of development is to iterate very quickly, make changes, and pull the community with by making these changes in a non-backwards compatible way. So you can't really expect features in Ethereum to be stable. That's not the goal. The goal is to be able to do innovation at a rapid pace in order to bring new features in. As part of the next iteration of that, which is called Metropolis, part of that was done in a phased manner, so that the first part of Metropolis, which is named Byzantium, a hard fork that occurred last week. Byzantium was an upgrade of a number of different features within Ethereum in order to move towards the goal of Metropolis, which includes some major changes to the protocol, to the EVM, to many other parts. So essentially, some of the features got pushed early or released as part of Byzantium. So what's in Byzantium? One of the interesting features, there's two interesting features that have to do with the smart contract language, the EVM. And those were the introduction of two new calls. One is return data, and the other one is revert. Up to now, if you had a compiled Solidity contract, at the end of executing that contract, you can return, but you can only return fixed size objects with the EVM. Now, that creates quite a few limitations in the way you can deploy smart contracts. So that change broadens the capability of the Solidity language, because now the EVM can support specific opcodes that allow you to return variable size data structures as the return value of a function. The second one is revert. Now, up to now, if you are running a smart contract and that smart contract terminates with an exception or a return value, then if it terminates with an exception and fails to execute, then all of the gas is consumed. And for contracts, there's no way to terminate without doing that. So up to now, if you wanted to simply terminate your smart contract without throwing an exception, it would still consume all of the gas. What Revert does is it gives you a new model where you can terminate execution of the smart contract without consuming the gas. So that's a new feature, a new capability. It's going to give some more flexibility to the Solidity language. A related change to that is a change in the way externally owned accounts or private keys are managed. So up to now, there are two types of there are two types of addresses in Ethereum. There are addresses that correspond to private public key pairs, also known as externally owned accounts, or EOAs. And then there are accounts or addresses that are managed by contracts, that belong to contracts. And how that money that's in that address is controlled is by the code of the smart contract. So there's been this very broad distinction, effectively, in accounts, these two very different forms of accounts. What Metropolis Byzantium is doing is it's adding the possibility of having an externally owned account with a private public key, but which operates through a smart contract. So even simple accounts that is doing simple value transfer can now have smart contracts attached to them. This is part of the change going to Metropolis, because the stated goal, I believe, is to do away with the distinction between externally owned accounts and smart contract-owned accounts, and to make all wallets smart contracts, obviously with one being a very simple smart contract, but have the rules managed by the EVM. Today, certain types of transactions, those that transfer value from an externally owned account to an externally owned account, do not execute the EVM at all. They simply are implemented as a state change within the blockchain. They produce a receipt, but they don't actually execute the EVM. Under Metropolis, the EVM will be executed for every transaction, including the ones that are just externally owned accounts. Romain asks a follow-up question, which is, even though this is an uncontentious upgrade of a network like Byzantium, it needs a hard fork. Is there any way to upgrade a blockchain without risking the creation of a chain split or doing a hard fork? There are ways to upgrade a blockchain without risking the creation, but those ways are limited and or require quite a bit more complexity, and those are called soft forks. So soft forks are changes that are backwards compatible. Hard forks are changes that are not backwards compatible. Ethereum has an explicit policy to make changes via hard fork to make it backwards incompatible, to require upgrade of the entire ecosystem. That does risk chain split, but only on contentious changes. Of the, I don't know, 7 or 8 hard forks that Ethereum has had, I don't know the exact number, only one has ever been contentious and caused a chain split, and that was the DAO fix with the hard fork, which created Ethereum Classic and Ethereum. So the other 6 or 7 or how many ever hard forks were pretty much uneventful. The entire network upgrades, things move on. I think that's what happened with Byzantium. There is no chain split. So the risk is relatively low as long as you have a development team that is really assertive with the miners in this case, as Ethereum is. And it's a very different model than that we see in Bitcoin. All right, let's go to the YouTube chat and see what kind of questions we've picked up from there. George asks, if you always sweep your received Bitcoin into a new address, doesn't this provide sufficient anonymity? Unfortunately not, George, because part of the problem is that when you touch certain other addresses, like when you do a transaction that involves sending money to an exchange or receiving money from an exchange that has KYC rules in place, know your customer rules in place, so they're identifying every one of their customers. The way they do that is by subscribing to an analytics company that will do risk scoring on every transaction, meaning that all of these exchanges are sending all of their transactions to this third-party company. Third-party company takes each transaction and tries to decide if the recipients are drug dealers or not, or some other criteria, if they're on a blacklist or not, and then tracks a certain number of hops back, maybe 3, 4, 5, who knows. What that means is that these analytics companies get records on who this address belongs to. They get personally identifiable information about the users, and they correlate and aggregate that across a very large number of exchanges, as well as a large number of merchants and merchant payment services. So if your Bitcoin touches an exchange or touches a merchant or touches a merchant intermediary, then your name gets attached at that point. And then after that, all of the other addresses that related to that, that sent and received for that, that were involved at the same time as inputs, all of those will get tainted, and all of those will get identified with you. So there goes your anonymity. It's not sufficient. And in many cases, these analytics companies will operate on 3, 4, 5 hops, which means that if that belonged to someone bad 3 transactions before, someone on their blacklist, then you're now on their blacklist, or your addresses are now on the blacklist. Eamon asks, can you please explain why second layer and further developments on the Bitcoin blockchain will not stop other blockchains? So for example, if there is a smart contract capability on Bitcoin, why use Ethereum? And the reason, Eamon, is really simple. It's because Bitcoin cannot adopt all of the changes made and all of the innovations of other blockchains and simply copy them, because many of these changes involve trade-offs. And these trade-offs, which are made by various other blockchains and made by Bitcoin, specialize each one of these blockchains into a function. So Bitcoin can't be everything for everyone any more than Ethereum can be everything for everyone, because the choices that make Bitcoin what it is make it less suitable for running smart contracts. And for example, the choices that Ethereum makes make it less suitable as a robust reserve currency. And so these trade-offs are what differentiate between blockchains. So this is a bit like, you have to understand that with these specializations come disadvantages. Imagine you have an agricultural tractor and a Formula One car. And you can say, well, which is better? And it really depends on where you're going to drive it. And everything that makes a tractor really, really, really good at what it does in a muddy field, pulling great loads, is exactly the same things that make it terrible at moving fast on a paved surface, racing other cars. And everything that makes a Formula One car really good at that automatically also makes it terrible at the other. And so you say, well, why can't we just start adopting the aerofoils of a Formula One and the tires of a Formula One and the engine of a Formula One and attach them to a tractor and then make it the best all-around vehicle? And I think you can see why that doesn't work. Anita asks, is the Enterprise Ethereum Alliance version of the Ethereum software decentralized, or is it a private blockchain? There isn't really a version of Ethereum that is the Enterprise Ethereum Alliance. As far as I understand it, the Enterprise Ethereum Alliance is an association. It's a human organization which has members and participants. How they actually each interact with Ethereum, some of them may run a clone of Ethereum as a private blockchain. Some of them may use the Ethereum public blockchain. I'm very suspicious, obviously, of companies running private clones of Ethereum. How you manage the security on that is a whole big unanswered question. So I don't think there is a single approach to the Enterprise Ethereum Alliance as to whether they run a private cloned version of Ethereum or the open public Ethereum. JZ asks, what are atomic swaps? Atomic swaps are simple smart contracts that use 2 smart contract building blocks, multi-signature and time locks, in order to enable what is effectively a payment channel between 2 different blockchains. So you know how you can build a payment channel, or maybe you don't know, but you can build a payment channel on Bitcoin. And if you put lots of payment channels together, you create Lightning Network. But the basic payment channel is a multi-sig channel with 2 participants who lock their funds together and then settle the balance of that channel off-chain, and then have a final settlement transaction that batches all of those changes. That's how payment channels work. An atomic swap is a very simplified version of a payment channel that's done for 1 transaction. Basically, both parties commit funds on their corresponding blockchains, let's say Litecoin and Bitcoin. They commit funds on these 2 blockchains. with a multisig where they are each participating in each other's multisig. And they use a secret nonce, which is a number that is hashed, and what's called a hash time lock contract, which is the ability to withdraw money after a time if you have the secret that made up that hash. And by doing that, by both committing that way, they can ensure that each of them can cash out on the other blockchain, thereby swapping. So one person puts Bitcoin in and gets Litecoin, the other person puts Litecoin and gets Bitcoin. Essentially, they do an exchange, a decentralized exchange, kind of like Shapeshift does, but without Shapeshift. The idea is that you do an exchange by simply creating these two transactions. Each of the participants doesn't need to trust the other one, because if the other person cashes in their multisig, the only way they can do that is by revealing the secret number, which then allows me to cash in my multisig. And if either party walks away from the deal, they can both get refunds after a short period of time. So it's a very secure smart contract way to swap one currency for another between two participants using an off-chain transaction and two on-chain transactions. Christian asks, could atomic swaps equalize the value of BTC and altcoins? No, Christian, because in order to do an atomic swap, the two participants must agree on an exchange rate. It's not done on a one-to-one basis. So for example, I might ask for 100 Litecoin per each of my Bitcoin, and the other person has to agree to that exchange rate. Usually, if you're building an atomic swap, what you're going to do is you're going to look at some exchange rates from some existing marketplaces, use those as the basis to decide what exchange rate you're willing to agree with the other party, and then encode that exchange rate in your atomic swap. So the atomic swap is not one-to-one. It involves an exchange rate just as if you were doing it on a marketplace. Yanis asks, what are the differences between altcoins and metacoins? I think I coined the term metacoin, no pun intended. And I don't know if it's broadly used, so it might just be my imagination. But basically, an altcoin is one that has its own separate blockchain. And a metacoin is a coin that runs as an extension in a layer or as part of an additional protocol within the same blockchain. So for example, if you have Bitcoin and you have a counterparty token, the counterparty token is a metacoin to Bitcoin. Ethereum is an altcoin to Bitcoin, or Bitcoin is an altcoin to Ethereum. They're on different blockchains. And then the ICO tokens on Ethereum are metacoins of Ethereum. So to me, the difference is whether you have a different blockchain or you're using the same blockchain but a different layer. All right, so that covers some of the follow-up questions we had in the chat. If you have more, now's the time to ask. Lazar asks, how can Demerara increase the velocity of money? Any examples of altcoins on that? So Demerara is the idea that you have money that has negative interest, whereby if you do not spend your money, over time it loses value. It sits in an account and it reduces in value as time passes if you don't spend it. So Demerara is a negative interest rate. You don't really see that implemented as a deliberate feature in the world, but you do see it implemented as a feature by central banks nowadays. There are several countries where bank accounts yield interest rates, meaning that if you put your money in the bank charges you a percentage every month to hold your money, and you lose that percentage of your money every month. The only example of an altcoin doing Demerara was an experiment called Freicoin, F-R-E-I-C-O-I-N, Freicoin, a German development team that built Freicoin, or at least a German name, and wasn't very successful. So I think we haven't seen any successful example of a Demerara coin. All right. Christoph asks, can we expect further Ethereum applications to expand in the future? Yes, absolutely. In fact, I expect we're going to see a much broader range of applications being built on top of the Ethereum blockchain. And while I think ICOs are a great early stage application and will have a very big impact in the future, I would hope that we don't see Ethereum simply become an ICO engine and nothing else. There is so much more potential in the area of Turing-complete smart contracts to develop a broad range of applications with different requirements beyond, say, ICOs and tokens. Christoph also asks, is Bitcoin Cash use of, quote, Bitcoin in its brand some kind of usurpation? Some people are complaining about that, and we saw a similar fight in Ethereum between Ethereum and Ethereum Classic. I believe Ethereum itself is a trademark, so people from Ethereum accused Ethereum Classic of trademark infringement. Bitcoin, as far as I know, is not trademarked, and but nevertheless, some people have accused Bitcoin Cash of trying to steal the brand or to pass off Bitcoin Cash as the original Bitcoin. And I wouldn't be surprised if some people have done that. But I certainly don't think that a disagreement between different groups within Bitcoin leading to a fork that is necessarily an attempt to steal the brand. I have no way of knowing the mental state or the reasoning why people built Bitcoin Cash or why they named it Bitcoin Cash. But certainly, there is a lot of debate on that. And I think that's going to become more broadly a difficult issue that's going to need a lot of discussion. So what's in a name? What are the parameters that a brand in the cryptocurrency space, where forking is an inevitable part of the evolution of any protocol, who gets to keep the brand, who gets to claim the brand? And the simple answer is that everybody claims the brand, and then the market sorts it all out by clearly signaling preference for one over the other. I think we've seen that happen in Bitcoin Cash. What are the top 2 or 3 merits or demerits of SegWit 2x versus the traditional Bitcoin chain in a nutshell, and what should that mean for users and miners? 2x is effectively a doubling of the base block size, leading to an 8 megabyte weight total block and a 2 megabyte base block size. And it's part of the New York Agreement, and it's intended to increase the scalability of the Bitcoin blockchain, and is it being introduced as a hard fork in November. So that's a bit of the background. What are the merits and demerits? Well, the general idea is that 2x has a relatively straightforward hard fork to 2 megabytes without an emergent consensus or mechanism for repeating that, and the kind of minor manipulation we did see it in some cases with, for example, Bitcoin Unlimited, that had the emergent consensus mechanism. Or the potential minor manipulation we could see in that situation. So there's a difference between changing the value of the block size versus handing over the power to change the value of the block size to the miners whenever they feel like it. And 2x, what it's doing is it's simply changing the value of the block size. It's not giving the miners the ability to change it. And that's the only real change. there is an ongoing debate at the moment about whether SegWit2x should include an opt-in replay protection mechanism that is effective and unambiguous in order to prevent user problems when executing transactions that are intended for traditional Bitcoin, if you like, or intended for the 2x chain, and instead get played on both chains. That can cause a lot of customer service problems with exchanges. It can cause a lot of confusion with users. So there's a very strong argument to be made that SegWit2x needs a replay protection mechanism. I expect we will see one introduced. I hope we will see one introduced to minimize the disruption. I think that's it with SegWit2x. We'll see how it plays out. All right, let's move on to the topic of ICOs. Joya asks, how easily can US citizens sign up for ICOs? It is my experience that I cannot even sign up for an ICO. Some of them list a disclaimer that you are not supposed to participate if you are US citizens. Others literally block you based upon your IP address. Well, Joya, the disclaimers and the geo-blocking you see for ICOs have to do with the fact that these ICOs are trying to avoid being exposed to the regulations of the Security and Exchange Commission, which can be a very high regulatory burden for some of these ICOs, and they're trying to bypass that regulatory burden or to stay out of under the radar for the SEC. So in order to do that, they're taking active measures to exclude US citizens. Actually, I think it's US residents, not just citizens, to exclude US residents from participation. So don't check the box that says that you're a US resident. You'll be lying and violating the rules of the ICO. Or use a VPN so they can't detect your IP address. Again, you're kind of lying and breaking the rules of the ICO. So that's how a citizen can sign up for, a US resident rather, can sign up for an ICO. I don't advise you to do that. I don't advocate doing that. You have to decide if you consider the SEC regulation a protection for you, or if it's a barrier for you accessing investments you want to access. But as far as I know, the issue has nothing to do with whether you are legally allowed to participate. It has to do with whether they are legally allowed to have you participate. So it's the ICO that breaks the regulation if it has a US resident. It's perfectly legal for a US resident to invest anywhere they want, with one exception, and that's the OFAC list, which is the State Department list that designates terrorist organizations and persons who are engaged in those activities who you are not allowed as a US resident to transact with. As long as the ICO and its backers and principals are not on the OFAC list, I believe, and I'm not a lawyer, but I believe that there's no obligation you have to follow those rules that the ICO sets, and you can participate in them. You're not breaking the law as a US resident by participating in an ICO. Second question by Joya, is China changing its position regarding ICOs? I have no idea. Right now, the Chinese Communist Party conference is going on. It's a very big deal. Every 5 years, they get together with several thousand delegates, and they have a big 5-year strategy planning meeting. And I think we may see some policy changes after this meeting. And certainly there were some abrupt policy changes in the run-up to this big meeting. And I think it's very much related to what's happening in that political situation. It's very difficult to tell exactly what the position on ICOs of the government of China is. Don't forget, China itself is not a single monolithic system. It is a very diverse, very large country with a lot of competing interests and activities. And even the Chinese Communist Party is not in charge of everything. So who knows? Let's go back to the YouTube questions and see what other questions we had. Mo asks, how can we evaluate an ICO and whether it's worth investing or no? I mean, I would evaluate it in many similar ways that I evaluate any other investments, and I'm not an investment advisor, but as an individual, I would look at the idea, I would look at the product or technology or solution that is related to that idea. I would look at whether a market exists or is likely to exist in the next few years, whether this company and solution can reach that market, whether this team that they have can execute on their vision to reach that market, and what their competitive situation is. So all of those factors would go into evaluating an investment in any space. ICOs are a bit different because one of the things that's happening is ICOs are allowing people to invest in an idea, even under the expectation that the specific company that takes the money may not be able to return anything to investors. It's almost like a research grant. Here's some money. Why don't you go play at doing sovereign identity or medical records or hard drives sharing or whatever. I want to see that idea happen, so I'm willing to put some money towards a team of seemingly talented individuals exploring this idea and pushing forward the state of the art, even if I'm not going to get a return on investment. We've seen that attitude, and in some cases, it's a subconscious thing that people love the idea so much they want to see it succeed, and they're not as concerned about whether they're going to get money back for their investment. That's a very different rationale from investing in a traditional sense when looking for a return on investment. One of the quotes I liked very much was the idea that ICOs are a mechanism that allow you to fund a group of developers to LARP out an idea, LARP being live action role play. So the idea being that you're funding these developers to go out and in an elaborate way do a live action role play of what it would look like to do a startup in this space so they can all learn something, which is a fun way of expressing this idea that what you're investing in is just promoting the idea rather than expecting a return. Nicholas asks, do miners' economic incentives change in any way if large amounts of non-Bitcoin value are transacted in sidechains? Yes, absolutely, Nicholas. And this is one of the considerations that has to do with the interplay between sidechains. One of the things about sidechains is that the security of the overall system is dependent on the security of the sidechain and the security of the main chain. And so as a result, if what you're trading on the sidechain has significant value, then it changes the behavior of the miners on the main chain. And main chain and sidechain is really not an accurate term because they're both sidechains to each other. There is no, one is not superior to the other, but from the perspective of who's mining which one, if you see transactions happening on a sidechain and you can do things on your chain to influence what's happening on that other chain, then yes, that will affect miner incentives, which is why it's important to have a well-balanced system whereby the sidechain itself is secure. If the sidechain itself isn't secure, then you have a problem. Anita asks, what is coin tainting? Coin tainting is a privacy problem that happens when two coins that are recorded under different addresses, under different ownership, appear in a transaction together, thereby signaling to everyone that the ownership of those coins is related, meaning that either the same person owns the coins or the coins are controlled by one entity, the keys are controlled by one entity, for example, an exchange, even though they're owned by many different people, and that the ownership is somehow related. So anytime two of your coins touch by being involved in the same transactions, which can happen if one is change or if you take two inputs to pay something and those two inputs are from different addresses, now everybody knows that those two inputs most likely belong to the same person. So the solution to that is to do coin mixing, where you have many, many people participating in the same transaction, so as to create all of this apparent tainting, where everything taints everything, but without any real ability to do analysis from that. So essentially, that means you're pushing out more noise to hide the signal. And the signal is that these coins may be related to each other. OK, let's go to another topic that a lot of people are interested in, that we're going to talk about next, which is, can ICOs lead to inflation? Since actual money or cryptocurrency is paid for tokens, and tokens acquire monetary value once they are traded, and the token holder can cash out the tokens for money, and the token issuer already has money or cryptocurrency. Before the ICO, one party had money, the investor. After the ICO, both the issuer and the investor have something of value, either money, cryptocurrency that was invested, or the tokens themselves. And therefore, the value has doubled. And in the long term, does this mean that more and more new money is being created out of nothing, which leads to inflation? Yep, absolutely. And so all of these ICOs are are creating all of this investment value that is being translated into jobs and salaries and paychecks and revenue for all of these companies from tokens that existed before. And yes, ICOs are creating inflation. And keep in mind, you see that in terms of the difference between the volume being traded and the total market cap of an ICO. So if I have 1,000 tokens that I've issued and I sell one for $100, does that mean now my tokens are worth $100,000? According to the market cap calculations, yes. And if you are able to sell those on a market and get that, which you won't be because they'll depreciate in value as you keep selling them, you will have a market capitalization of $100,000. Where did that market capitalization come from? It came from the issuance of the tokens. So yes, this is inflation. This is printing money. ICOs are printing money. They're printing money, but they're also sucking money out of the other economy. So at the same time that you see money being printed in the ICOs, that's also withdrawing Ethereum from circulation. Some of that Ethereum is going to remain withdrawn for circulation for some time, and that will create some deflationary pressure, actually, as long as that amount is greater than the amount coming in to Ethereum. So it's a complicated situation, but on a very basic level, ICOs are creating new value, new money, new economic activity, and so they are inflationary in nature. Servius asks, any thoughts on Russia's crypto ruble? And I'd like to take that question and make it a bit broader. So if you haven't heard this, this idea, Russia's central bank, I believe, has announced that they're going to be launching the issuance. They're going to issue a blockchain-based national currency that's called a crypto ruble, which will be exchangeable on government-run exchanges for rubles. So you'll have a one-to-one exchange rate for rubles, with an issuance controlled by the central bank, and with the blockchain controlled by the central bank and signed by the central bank. So it's a proof of authority blockchain. It's not mining. It's not an open blockchain. It's not a decentralized blockchain. It's not a censorship-resistant blockchain. It's not a neutral blockchain. It's not a borderless blockchain. It's not any of those things. So what is it? It's a distributed ledger. And what it is a form of digital money that is slightly more decentralized than the digital ledger of the central bank itself, which is hidden. So this is slightly more decentralized because you may have multiple copies of it, and you may have some level of transparency. At least some of the banks will be able to see this ledger. So it's a form of digital currency, but it's a form of digital currency that, in my opinion, takes away all of the interesting facets of digital currency. You are not open to participate. It's not open to participate in the consensus algorithm. You are not allowed to innovate without permission. Transactions can and will be censored. It is not neutral, quite the opposite. It is promoting a very specific geopolitical agenda. Its issuance is controlled centrally, which means that you don't have a deterministic and predictable issuance rate. It can be inflated as much as the central bank wants. So, and it's not just Russia. I think many countries will experiment with this. One of my greatest concerns with this overall issue is the idea that this can be secure. And that security relies on a set of keys that are centrally controlled. And my concern is that because the blockchain as a centralized entity no longer has the security mechanism of decentralization, the question is, what security mechanism does it have? And if the security mechanism is simply, don't worry, the Russian government will keep these keys very secret, then we have a problem, because we know for a fact, with ample evidence of the last 20 years, that no organization can maintain a secret, super secret thing forever. Things leak. And when you have potentially billions of dollars riding on this, and the incentives to compromise these keys, like imagine what you could do if you could compromise the keys. You can deny transactions. You're going to have to force a reorganization. You could even issue rubles in large amounts, cause a lot of disruption to the system. They'd have to change the keys, which all kinds of problems with doing that. So centralized control is a weakness, and the security model for state-based, nation-state cryptocurrencies based on closed blockchains with proof of authority is yet to be tested, and it will be tested. Stephen asks, what is it that Bitcoin has that makes it survive forks, altcoins, and bad news? No matter how bad the news, it dips and recovers. New features in altcoins like privacy and speed, dips and recovers. Bitcoin still survives. What is it? That's a great question. I don't really know what it is. And in fact, many of us have been surprised by the incredible resilience of Bitcoin. I think something about the fact that the consensus requirements are so strong, and it's so difficult to violate consensus. Something about the fact that because Bitcoin was the first and it grew big enough before anybody noticed, that gave it this kind of advantage, a first mover advantage, very large size advantage, a lot of money at stake. Everybody who's involved in Bitcoin from the early days now has an investment in the survival of Bitcoin. Quite literally, if you own a lot of Bitcoin, you are invested in the survival of Bitcoin. So, and the system itself evolves continuously and dynamically adapts to threats, which has an element which Nicholas Nassim Taleb calls anti-fragility. It's an interesting concept. There's a lot of debate about whether Bitcoin is in fact anti-fragile or not, but a lot of the ups and downs we see make it look like it's quite anti-fragile. So let's see. Honey Badger doesn't care. And with that, I think we can close the 7th session of the massive open online course for the University of Nicosia. This is Andreas Antonopoulos. I've been with you answering your questions for session 7, and I'm looking forward to our next session. In the meantime, participate in the forums, ask and answer questions with each other, and get me some great questions for the next session. Thank you so much.